Good afternoon, Peter Klein, Chief Investment Officer, co-founder, ALINE Wealth. We wanted just to spend a couple of moments with you today. This will be a quick one. I want to just go over where we're seeing opportunity and where we're seeing, frankly, some concern. Allow me to share the proverbial screen, and we will endeavor to move forward. Here we go. Okay. All right. Last month, we talked about this notion of our dual mandate. We talked about what is a wealth manager, not a portfolio manager or a hedge fund manager or a trader or some other element of the multifaceted, Wall Street community. The work that we do at ALINE Wealth as wealth managers has a higher standard. Besides the fiduciary standard, it's also a caring standard, right? Because in the end of the day, the buck stops here. We're working with people's life savings, their aspirational living, their goals, their children's money, legacy money, foundations, endowments. And we need to be careful, especially in markets like this, when we're investing this kind of capital. So I spoke last month, and I wanted to just make sure I indicated it again today about the dual mandate of growing assets, critical part of our work. We spend so much time on understanding the markets and where the opportunities might be, but also the duality of protecting the assets, also critical. And this idea that as a wealth manager, we're charged with both of those responsibilities. Here is how we define wealth management at ALINE Wealth. We went over this last month. I won't spend too much time on it, but it's investment consulting, it's planning, and then the very important proactive empathy, caring, communicating, speaking, making sure our clients know what we're thinking, have a plan going forward on how to execute, and they can then tell other folks who may not have that kind of relationship with their advisor about what we do here at ALINE Wealth. It's a process. It's a very defined process. We call it the wheel, and it starts with understanding and listening to our clients and what their objectives are and their risk constraints. And it's a whole multifaceted process that goes through from asset allocation to portfolio construction. Communication is a critical piece that I think many financial advisors forget or miss. Clearly, the portfolio managers, the hedge fund managers, don't even do that. They're just in some ivy tower somewhere, and they're doing their thing. They don't have to talk with Mr. or Mrs. Jones and explain to them what's going on in the markets and what's going on in their lives and how can we help them stay on the right path. So communication is also critical. ALINE takes it very seriously, and you've seen many of our newsletters and our videos and our white papers. So you'll see much more of that going forward. We believe Black Diamond is a game changer. It allows us and our clients to understand better where they're positioned at any moment in time. A click of a mouse and boom, you're right there. You're seeing the portfolio, you're seeing your exposures, you're seeing how you're doing from a return perspective and a risk exposure perspective. Also important, and it's right there available for your use. Obviously, it's available for ours as well. There's no additional charge for it. It's part of the engagement. Black Diamond, game changer. I want to go into the next section with starting off with this quote, and I thought it was so apropos. And who else but Warren Buffett, the Oracle of Omaha? The less prudence with which others conduct their affairs, the greater prudence with which we must conduct our affairs. I think that's telling, especially in the current conditions that we're seeing in the market. I'll let you ruminate on that as we move through some charts. So first, right back to Buffett again. I thought it was apropos. I'm repeating this from last month. Berkshire Hathaway has a huge cash pile. There's a reason for that. They would be putting that money to work if they felt compelled. So that should give you some pause. And we also have a substantial cash hoard as well. Now, on a macroeconomic level, we've been speaking about this potential for the second wave of inflation, the stickiness, this this inflation that's not yet vanquished. And I believe strongly that that is the case. And this particular chart from our friends at Apollo show that there is a percentage of items with at least 3% monthly price growth. So you see here that there are elements to the CPI basket that are showing a higher inflation. Now, again, of course, oil prices and energy prices and rent have a big impact on that. But if you strip out and you look at maybe super core inflation, it has been stubbornly sticky. And I think that's the way we're going to see it for a while to come. And that has implications on how we want to manage assets. Some market internals, Mag 7 versus everyone else. As you could see here, that should give you some kind of wake-up call a little bit to where we're seeing. I mean, it just seems like it's a huge delta here. And the next slide, I think, even shows it. Interesting. This is over a 2-year period, 24 months. The red line would be like the equally weighted index, if you will, versus the S&P 500, the cap weighted index, right? So remember, there's two ways of looking at the S&P. There's 500 companies in there, 500 stocks. If you equally weight, in other words, each one is 1/500th, that's the red line. And then you say, okay, well, show me the S&P. It's often quoted every day. And that's the cap weighted, where the biggest companies have a higher percentage. In fact, the 10 largest are 40%. 10 out of 500, 40% of the index. That should give you some head scratching there. If that's this line here, that's that blue line. So what it's showing you is they're 30% above the equally weighted index. Same stocks. Just that the cap weighted is much higher performance-wise. Now, if you look down here over the years, that has not been the case. In fact, the last time we've had such a disparity or a delta between the two was back here, and that was sort of the 2000 sort of .com correction crash. And then you see all for this period, it was sort of below equally weighted. And then, of course, the last couple of years, we've seen huge growth. Okay. And then when we talk about margin of safety, and we do a lot of work on looking at this when we look at individual companies and do our bottom-up analysis, what we're looking at here, though, is holistically on the entire equity market, S&P 500 here, what the risk premium is. In other words, how much are you getting paid while investing in the S&P 500 versus what you would have gotten in treasuries? In other words, risk-free, and then you have, obviously, risk in equities. What's the premium? Now, you want to kind of think about this as the following way. If you were investing in equities, you should be getting, there should be a premium to that, right? In other words, there should be a premium you should get more return for investing in risk. In reality, though, as you can see here, that it lately has come down. So the premium has come down. So you're not getting, I guess the best way to say it is that maybe, the juice is not worth the squeeze. Let's think about it that way. And that squeeze can be painful sometimes. So that's something to think about, right? Are we getting the return that we deserve given the risk we're taking? That's how I would like to talk about it. So far, it's not that case. So you want to be buying equities when the risk premium is high, right? When you're getting paid to take that risk. Okay, some stuff on AI, right? Squaring the proverbial circle. So McKinsey and Company estimates the cumulative spending on AI is 6.7 trillion. I can't believe it. $6.7 trillion on data centers globally through 2030, cumulatively. All right, that's the next 5 years. So including that's about 5.2 trillion in capital expenditures and those equipped to handle the AI processing. Essentially hyperscalers. So where is this money coming from? Where is this, $6-7 trillion coming from? If you look at the Mag 7 in 2024, they generated about 500 billion in combined cash flow. Now you strip out about a third of that they need to keep their business going, this idea of, free cash flow or capital spending. And you're left with about $330 billion. Now, that's assuming no buybacks, no dividends, no M&A. Okay. If all of that was to be going to the AI build out, how much would it, it's going to take you without leverage about 15 more years to do that. So that suggests that there's likely to be more leverage. And we're beginning to see that. And that's disconcerting because up until now, these companies haven't really deployed leverage. They haven't had to because they were cash flow behemoths. Well, they may not become that if they're spending all this on AI build out. And then Bain and Company states that AI revenues would need to reach 2 trillion by 2030 to get a good return, to get an adequate return on the 7 trillion that they're that they're investing, right? So that's about 100, that 2 trillion, that's about 100% of today's global advertising and subscription revenue combined globally. Digital media subscriptions, all in 2 trillion. So that would suggest they would have to get the entire market. They would have to own the entire market globally for that to happen. And just sort of, bring it back down to ground zero here a little bit. Hyperscalers in 2025 reported a combined AI revenue base of only $100 billion. So it sounds like we got a ways to go. I want to show you this is the circularity that we showed you last month. This gives me some pause. We've seen this movie before in 2000 with the build out of the internet. It looks like there's a lot of incestuousness going on here, and that gives me some concern on the financing side. Otherwise, also, in addition, I'm concerned about obsolescence risk. Do we think, that the rest of the world is not looking at this AI and saying we want a piece of that? In fact, how many graduate school level software engineers are there in India and China doing just that? So this is, what I look, when we're doing the work that we do, we want to always look where the puck is going. And it seems to us that this is just not going to be just a US phenomenon. So with that, I want to thank you for the opportunity to spend a couple of minutes with you today. Wishing you and your loved ones and your families a very happy and healthy Thanksgiving, and look forward to chatting in the next few weeks about the portfolio, about the financial plan, about the estate plan, the work that we do for our clients as a fiduciary and as someone who cares. Bottom line. Thanks very much.